Welcome to this week's IBKR Podcast. I'm Andrew Wilkinson. Joining me today, Steve Sosnick, Chief Market Strategist here at Interactive Brokers. Welcome, Steve.
Hello, Andrew.
And Jose Torres, Senior Economist with us here in Greenwich, Connecticut. How are you doing, Jose?
Hi, Andrew. Hi, Steve. Great to see you both.
All
Jose,
right.
you brought some tough weather with you. I wanted the Florida weather, not the 40 degrees and rain, but
No chance of that this week.
Nope.
So, folks, last week Liberation Day came and went. And in some corners, it's been renamed Obliteration Day on account of how equity markets have received the news. I think JP Morgan's raised its recession risk to 60%. Goldman Sachs increased its recession risk to 45%. Jose, I'll start with you. Despite the strong employment report to cap off last week, a recession seems far more likely now, doesn't it?
Absolutely. The tariff concerns are totally offsetting the positivity viewed from the jobs report last week. The tariff rates are going to be roughly 25% on U.S. imports. That's the most in over a century. So we're talking about a significant shift in the way companies and businesses do business. But then also we're looking at a significant change in firm financial statements and how bottom lines are going to weather the elevated uncertainty as well as a potential for rising costs. We're looking at compressing margins, looking at an environment where earnings growth is going to be hard to achieve with these policies. And because of those headwinds, the market has adjusted lower.
Steve, what's the feeling across Wall Street? How would you phrase this?
Dismayed. I think I described it in the Wall Street Journal. I said there was a lot of confused, scared, and angry people out there. And I think that applies. I think that the reaction, the news itself, and it caught a lot of people by surprise, and the reaction shows that. And then for people who are not necessarily in the markets all day in, day out, they're confused and in many cases nervous. They're looking at their 401ks. I'm getting a lot of calls from friends and my kids' friends. What do I do? Unfortunately, I think the market was craving a little bit of empathy from some of the people who, in the administration, and we didn't get it this weekend. I overdosed on news shows this weekend, and I think Treasury Secretary Bessent tried a very intellectual approach. I think it was not necessarily well received, but I understood what he was doing. And I think Commerce Secretary Lutnick and Peter Navarro, a senior counselor, were almost combative. That's not what investors wanted. They wanted some reassurance. They wanted a pat on the head, and they didn't necessarily get it. And so I think right now the market mood is very stressful. Volatility of this nature both reflects stress and causes stress. And this is what we're living through right now.
Jose, whose problem is this? Is it Donald Trump's, or is it a problem for the rest of the world? And how does it resolve?
Real quick, I just want to go talk to a little bit of the point that Steve mentioned earlier. Equity bulls thought they caught a reprieve today at around 9:45 a.m. when economic advisor Hassett News stated that President Trump was considering a 90-day halt on the tariffs ex-China. And the market, I couldn't believe my eyes. The S&P went from like 49.50 up to 52.46 or so.
It was over an 8% trading range.
Yeah. So that was insane I'm writing my morning commentary. And for so long, Andrew, the market has been conditioned to, when you have that volatility, something happens, someone comes out, and then you get to that buy the dip moment. But today, that moment was very short-lived. It didn't last long because once the White House said that was fake news, then the gains were immediately pared back, albeit not back to the lows of the day at 48.35, which is roughly pretty much flat since January 2022. That's roughly the same level we were at three and a half years ago, roughly, on the S&P. So I guess back to the question, is it Trump's problem or is it the whole world's problem? At this point, President Trump is trying to accomplish some difficult goals, and it's a risky path. It's a path that we can go on as an economy, as a nation, and it doesn't necessarily guarantee us any benefits in 3 to 5 years from an onshoring manufacturing standpoint. Now, on the fiscal balance front, the issue is that this market has had so much fiscal stimulus post-COVID, and we're not conditioned to seeing a pullback of that magnitude, even if it's just slight, because we're conditioned to seeing it grow. So the trade policy, while at the same time the government spending reductions are really significant headwinds to this market. And when we look at austerity measures in the past, we see that they are painful for economies and for markets. As far as the world, especially the developing world, stands to feel the impact the most relative to the US and Europe. The impact is likely to be worse. I think we're looking at a global recession here if these aggressive trade policies aren't pared back shortly.
Steve, we're knocking on the door of a bear market. We're probably there in the case of some indices. What are your thoughts from here? Where can we go?
I think the answer lies in the question you just asked, Jose. It's up to the administration at this point because, first of all, I'm not in love with the technical thing of 10% is a correction and 20% is a bear market. And I think we may have gotten to 20% on the S&P this morning for a microsecond there. Those are sort of artificial distinctions. Right now, it's more about mood. It's more about sentiment. And I think the sentiment has gotten so resolutely negative that has that bear market feel to it. And the bounce today had that bear market rally feel to it. Although I will say, if it was true, if it had been true, there would have been real justification for a rally because that would have been genuinely good news. But even bear market rallies, I always say, are short, sharp, and ferocious. Nobody likes missing a decline. We still see a lot of dip buying activity. I don't know where dip buying becomes a falling knife. I think at this point also, you've got the markets desperately looking for either a Trump put or a Fed put. I think there were plenty of opportunities over the last few days to get a Trump put, and we didn't get it. Basically, there has been, as I mentioned earlier, no sympathy regarding no inclination to do anything specifically to assuage the market. And so they're very tied into this policy, which has a lot of detractors, even on the right. There's a lawsuit filed by a group backed by Leonard Leo and Charles Koch, who are not exactly left wingers, against the tariffs. And also there was a guy on Bloomberg Radio, the Heritage Foundation, expressing concerns about this. So there's bipartisan concern, which I think in some ways is reflective of the bear market mood. And as far as the Fed put goes, one of the things I like to remind people is, number one, we don't know what the strike price is on the Fed put. They don't tell us. And number two, it actually has nothing to do with equities. Yes, the first Fed put, and I'll put the link somewhere in the chat in here. I wrote about this years ago. The first Fed put came about as a result of the 87 market crash. And yes, it was done. The Fed intervened in response to the market crash, but it wasn't because the stock market had crashed per se. It was because the effects of the stock market crash were being felt in the banking system. And I wrote about it because I remember very vividly being in a meeting morning and just basically saying the specialist system is broke. Some of the banks that deal with some of the banks that back the specialist firms are in trouble now. And remember, you had a 5-day settlement cycle then. So it was very difficult to wrestle with at that point. And so the Fed put had nothing to do with stocks. It was the banking system. And so as of now, we're not seeing those stresses. We're seeing credit spreads widen. We're seeing interest rates themselves because of the flight to safety. We'd seen a big rally in treasury bonds. Again, you're seeing some dispersion between high yield spreads, and that may resolve itself in some negative ways. But until now, and maybe Jose can give you some clarity on this one. The one thing I've really been searching for an answer for is if the two elements of the Fed's dual mandate work in opposition to each other, which one do they come down on the side of? So tariffs are likely to raise prices. I think Powell regrets using the term transitory, but there's certainly a ratchet effect. They push them up quickly and then the price rises get filtered through, but you can't, in any event, you'll have higher prices. And as of now, though, the market doesn't not need the full employment stuff right now. And so we have a real issue here of what happens if what happens if the labor market turns into reverse and the Fed would be inclined to preserve the full employment part of their mandate, but yet at the same time feel constrained because of rising prices. What gives? I don't know.
Yeah, Steve, I have a strong opinion there. I think that when the labor market starts to slip, even if the CPI is in the mid threes, I think the Fed will still come in and dish out some cuts. I think the bias in the last post-pandemic has really tilted towards preserving expansions at all costs and not necessarily caring much about price pressures in the short term. In the past, the mandate was sort of 50-50, but I think it's moved into a 70-30 kind of framework.
Okay, thank you.
One gets the impression from watching the news and from what you're both saying here that the administration really doesn't seem to care about the stock market, at least at this point. Is there something that might change? Maybe it's time that not necessarily heals this, but that is there a point when they can't ignore the volatility in stocks? I'll throw that one to Steve first.
You know what? The president is very dug in. He's not, as of now, he's given no inclination to change his mind. Maybe the political winds get so strong, maybe enough people can say that this is problematic, but this is a very strongly held view that he's had, and he's held it for decades. So he's quite consistent in that regard. I think it would be there's certainly some tweaks that can be made, because I think by imposing tariffs on something like Madagascar because we import too much vanilla from them. We don't have a vanilla industry to protect. Countries that have surpluses because they sell us tropical fruit. We don't have much of a tropical fruit industry to protect. So I think whereas in the first Trump administration, the market was okay with the tariffs, and many of them were actually extended by the Biden administration because they tended to be targeted and strategic and somewhat limited and certainly focused. Now what we're getting is tariffing everything, which is just making the price of everything go up. And I think that's what the market really objects to, was the haphazard nature and the fact that you're just causing the prices of all sorts of things to go up, whether or not there's any U.S. industry or strategic interest in protecting them. And that's really where it becomes very problematic. What gets that to change? I don't know, because you're asking me really to get inside one person's psyche, and I can't do that.
Yeah. Jose, the same question, but let me just throw in a couple of wrenches here as well. Any chance of a US downgrade, or what if the US dollar falls out of favor massively as a result of both a debt downgrade or just the policies that we're seeing unraveling?
I don't know. I don't know about a debt downgrade. I think that fiscally, we're trying to make some tough choices that aren't necessarily negative from a longer term perspective. As far as the dollar, the treasuries are still largest, most liquid market in the world. We're still the reserve currency. I don't know. Remember also President Trump is probably only going to have one term. I know there's rumors out there, but this is probably his last term. So I don't know if other countries are going to want to get away from us or disassociate themselves too much, while recognizing that there could be a new leader, a new control in the Congress, both in the House, likely in the House, not so likely in the Senate, that could produce some kind of offsets on the Trump administration's wants come in 2027. So there's definitely a lot of uncertainty out there. Some things Steve was talking about earlier were the Republicans and how some of them have been free traders for a long time. And then you have this bifurcation where a lot of them are moving on towards the manufacturing onshoring perspective. And I think a lot has to do with, remember, the Rust Belt delivered a lot of those votes that President Trump needed to defeat Vice President Harris in November. That's trying to stay on the voter base's radar. Also, folks think that because we've been embracing free trade for so long, that other countries have taken advantage of us. and we've lost some of our manufacturing prowess, and we aren't as diversified as an economy. So there's points on both sides there. And then one other thing is that from 2022, when we had the CPI handle up at 9%, what drove all the progress down to and change was goods, physical products, those things that are going to be reversing in price.
Mm.
They're already reversing in price, but they're going to continue in the next few months if this isn't pared back significantly. So we're in a stagflation kind of environment in the short to medium term. In today's trading action, April 7th was really interesting because you have commodities crashing from a demand perspective. So crude oil is down to a 49-month low, right? So commodities are crashing because of demand worries, but treasuries are also selling off because of inflation worries. The treasury yields are up on the long, led by the long end. So we're seeing some of that interesting action where you have like demand worries but inflation concerns simultaneously.
Steve, let me ask you one final question. Could this get so acrimonious China might have the upper hand here and decide to sell treasuries?
I think we often lose sight of the fact that our largest single export is actually our debt. And do think there's a concern there that might be part of the reason why you're seeing treasury yields kick up, because you might be losing a source of demand, or one of the more faithful buyers might say no. Also, Japan is a big buyer and they might use it as a retaliatory measure. It's quite possible. Again, these are like big geopolitical moves that are hard to predict, but I think it's not an idle concern. Let me put it that way.
Steve Sosnick and Jose Torres, thank you to both of you for joining me on today's podcast. And don't forget to the audience, subscribe wherever you download your podcast from. Thanks, gentlemen.
All right. Thanks, Andrew. Thanks, Jose.
Thanks, Steve. Bye, Andrew.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.